So you've probably heard the old saying that in life there are two things which are certain: death and taxes. And I don't have the secret to the elixir of life to help you live forever. But there are some ways that you can legally pay $0 in taxes on your income. And today we're going to talk a little bit about that, with apologies to Ben Franklin, who was the one who said that. So let's talk about 3 ways that you can pay $0 legally on your income. So let's start with the easiest method, right? Method number 1, make less than the deductions that you take. So quick easy example, here in 2024, the standard deduction is $14,600 for an individual, or for a married couple, $29,200. So leaving state tax brackets aside, because those differ from state to state, if you make less than $29,200 between yourself and your spouse, you would pay $0 in federal income tax. Easy enough, right? But for most of us, we need a little more than that to live on for our lifestyles, so what other options do we have? All right, so method number 2, which by the way can be combined with method number 1, is to use investment income up to the 0% exclusion tax bracket for capital gains. So the capital gains 0% tax bracket, meaning that anything under this level can be excluded from your capital gains taxes, is $94,050 here in 2024. So if you make $94,050 in capital gains income between yourself and your wife, or spouse, or whoever may be, yourself and a married partner being the key, then you can exclude that entire piece. And if you're single, it's just half of that amount. Then you combine that with the standard deduction. So again, let's say $29,200 if you're married, then you can make $123,250 between your regular earned income and your capital gains income, and still pay legally $0 in income tax, right? So this is all well and good, but what if there's more that we need? All right, so this is method number 3. And this might not be a viable option for all of us. Usually this is something I see used by my high net worth and ultra high net worth clients, in part because the higher your net worth, the more assets you have to use this strategy with. But the way it works is method number 3, take a loan against an existing asset or assets. So what do I mean by that? Well, let's go through a quick example. Let's say you're a business owner, as many of my clients are, and you want to take a loan out against your business, okay? And let's say you have a business out there that's worth, let's just say $10 million for an easy mathematical number. And you want to take out a $1 million loan against that business. You go to the bank, you say, I'd like $1 million. Hopefully you got a good relationship with the banker. They write up the loan, you get the $1 million in your account. Are you taxed on that? No. In other words, that $1 million is not, in the eyes of the IRS, considered a taxable transaction because it's a loan. In other words, because you have to eventually pay it back, or your beneficiaries, remember death is inevitable too, and many people do this on purpose, you do not have to pay taxes on that $1 million you took out. But in the meantime, you've got $1 million to play with for whatever the term of that loan is. And if it's dozens of years into the future that loan is eventually due, well, guess what? You basically got $1 million tax-free. Was it your own money? Yes, but think about it like this. If you had to sell that $1 million chunk of your business, you are going to probably end up paying a significant amount of capital gains taxes on it, because chances are that if your business was worth $10 million, it wasn't worth $10 million the day you started it. In other words, your basis. So that is a common strategy that, again, I see among people with significant assets, and it doesn't have to be a business either. It could be, a large 401k. You can take a loan against your 401k. Now, not up to $1 million, but you can take a loan against your 401k, and the benefit there is that you can pay the interest back and it goes to yourself, essentially, right? Another example would be a whole life insurance policy, or some sort of permanent insurance policy, such as a universal life or variable universal life. This is also a common strategy among the high net worth, where they have these large insurance policies and they take out a loan against the policy at a super low interest rate. And then, they have no intentions of paying it back They just use that income to live off of. And then when they pass away, basically what happens is the loan amount decreases the death benefit by whatever amount is left outstanding. And because it's a loan, it's not a taxable transaction. So hopefully these, again, just a few methods, certainly not an exhaustive list, but hopefully these get your creative juices flowing as you're looking at your tax return this year and thinking, you know, between my investments, my assets, and my liabilities, how can I start using these different elements together to help me achieve my financial goals? And if you'd like to sit down with me and figure out how do these different pieces work together, how do I make this plan work, how do I put together a plan if I don't have one, then drop us a line, like the video, give us a subscription here on YouTube. We'd love to see more of that. And in the meantime, I'll see you out there.